Honestly, it's been a really tough environment for investors in the retirement sector. So we've gone through a period of really high inflation, really high interest rates, and a soft housing market. We've also had Ryman Healthcare do 2 very large equity capital raises, which has taken a lot of buying tension out of the market as investors went to find that money to support those capital raises. Year to date, Ryman's down about 35% and Somerset's down about 10%. So it's been quite tough for investors. Well, so when we consider how soft the economic backdrop has been, we're actually quite happy with the operational performance out of Somerset and Ryman. And although the share price has reflected a tough trading environment, we do think it has been probably too negative at times. So recently Somerset's recorded another record quarter for sales, and we observe they've got a really great development pipeline too, so we love that about Somerset. For Ryman it's been a little tougher going, although their quarterly sales are improving. We observe they've got good discipline around pricing and sales now, and sales are going so well in fact that we expect that when Ryman next report they're going to upgrade their sales guidance. So we see 2 main things driving both supply and demand in the retirement sector. So on the demand side, it's just changing demographics. So the population is getting older. So those aged 65 and plus represent about 17% of the population today. It's expected to go to about 23% over the next 20 years. And those aged 85 and over, that percentage as a percentage of the population is expected to triple over that same time period. So that's on the demand side. On the supply side, we observe that new consents and new developments of retirement village units has really slowed down. So just these supply and demand dynamics just play in the favour of incumbent operators like Somerset and Ryman with large development pipelines. So the housing market's closely connected to the retirement sector in 2 ways. So firstly, prospective residents need to sell their residential properties in order to move into a retirement village. So the housing market's slow, that process is slow. And secondly, a lot of investors use the retirement sector as a proxy for residential property. So if there's negative sentiment in the residential property market, that typically flows through to the retirement sector as well. So more recently, we observed more positive data out of the housing market. So nationally, sales have increased about 2.5% year on year. And we also observed that the median house price in Auckland has started to improve over the last few months. So if these trends continue, we expect that positive momentum to flow through to the retirement sector. And in fact, we view the improving housing market as a major catalyst for share price performance in the retirement sector.